In the constantly evolving landscape of global finance, few assets provoke as much debate, speculation, and passion as Bitcoin. Over the last decade, it has been hailed as a revolutionary store of value, dismissed as a speculative bubble, and resurrected again as a cornerstone of the digital economy. Today, as we stand at the crossroads of shifting monetary policy, regulatory reform, and technological integration, the question before us is not whether Bitcoin will survive, but whether it is positioned to outperform traditional assets such as equities and gold in the years ahead. Recent market performance might suggest skepticism is warranted. After 2 consecutive years of extraordinary gains exceeding 100%, Bitcoin's momentum slowed considerably in 2025. The digital asset is on track to close the year down approximately 6%, underperforming investor expectations and disappointing those who anticipated a continuation of its historic rally following the return of a pro-crypto U.S. administration. However, as history has repeatedly shown, periods of consolidation often precede significant upward moves. According to recent analysis by the crypto research and brokerage firm K33, Bitcoin's current weakness masks a powerful structural setup that positions it for significant outperformance in 2026, not only against other cryptocurrencies, but against traditional benchmarks such as stocks and gold. Today, I will outline why Bitcoin's apparent underperformance may actually represent one of the most compelling long-term opportunities in modern financial markets. I will focus on 6 critical catalysts identified by K33 that collectively point toward a strong and sustained rally ahead. First, Bitcoin's current valuation presents a compelling entry point. Bitcoin is presently trading near what analysts describe as pre-Trump levels, reflecting a sharp pullback from its all-time high of approximately $126,000. From that peak, the asset has declined more than 40% and nearly 24% from levels seen at the beginning of the year. On the surface, this appears to be a significant downturn. However, valuation must be assessed in context. K33 argues that this drawdown is not a reflection of deteriorating fundamentals, but rather the result of temporary dislocations within the crypto market, namely speculative excesses and short-term leverage imbalances. When prices fall despite improving long-term fundamentals, the result is not weakness, but opportunity. In this sense, Bitcoin is increasingly viewed as undervalued relative to both its historical performance and its macroeconomic potential. Second, the macroeconomic environment is turning decisively in Bitcoin's favor. Interest rate policy plays a defining role in shaping capital flows, and the coming shift in U.S. monetary policy may be one of the most significant tailwinds for digital assets. While the Federal Reserve is expected to maintain rates in the near term, markets are already pricing in multiple rate cuts throughout 2026. Lower interest rates typically increase investor appetite for growth-oriented and alternative assets by reducing the attractiveness of cash and fixed income instruments. This environment historically benefits equities and risk assets, but Bitcoin, with its fixed supply and global liquidity, stands to gain disproportionately. Importantly, this monetary cycle differs fundamentally from previous tightening phases in 2018 and 2022, when aggressive rate hikes directly pressured speculative assets. The expected easing in 2026 creates a markedly different backdrop, one that favors capital reallocation toward innovative and non-sovereign stores of value. Third, the political landscape has become significantly more favorable to cryptocurrency. The current U.S. administration has signaled a clear shift in tone and policy toward digital assets. President Donald Trump, now in his 2nd term, has openly positioned himself as a supporter of cryptocurrency innovation. His administration has taken concrete steps to integrate crypto into the broader financial system, including appointing crypto-friendly regulators and endorsing market-friendly policy reforms. This political alignment matters. Regulatory uncertainty has long been one of the largest overhangs facing digital assets. When governments clarify rules, markets respond with confidence. According to K33, the current administration's approach represents a structural shift rather than a temporary political gesture. As regulatory hostility fades, institutional capital that once remained on the sidelines will likely enter the market more aggressively. Fourth, the establishment of a U.S. strategic Bitcoin reserve represents a powerful structural development. One of the underappreciated factors in Bitcoin's outlook is the U.S. government's accumulation of digital assets through seizures and forfeitures. Estimates suggest the government currently holds approximately 233,000 Bitcoins, valued at around $20 billion. Historically, these holdings were perceived as latent sell pressure, with the assumption that seized assets would eventually be liquidated. However, the current strategy appears to be shifting toward long-term retention rather than disposal. If the government continues to hold these assets, it effectively removes a significant supply from the open market. This change has profound implications. Bitcoin's supply is inherently capped, and any reduction in available circulating supply increases scarcity. When combined with rising institutional demand, this dynamic creates a powerful upward force on prices. The mere existence of a strategic reserve sends a powerful signal. Bitcoin is no longer viewed solely as a speculative asset, but as a strategic financial instrument. Fifth, retirement accounts may soon unlock a massive new source of demand. Another potential catalyst lies in the evolving treatment of cryptocurrencies within retirement portfolios. An executive order signed in August initiated a review of rules governing 401k plans, opening the door for broader inclusion of alternative assets such as Bitcoin. The implications are significant. If even 1% of total 401k assets were allocated to Bitcoin, it would translate to approximately $87 billion in new demand. This influx would not be speculative capital chasing short-term returns, but long-term retirement-driven investment, seeking diversification and inflation protection. Major financial institutions, including Morgan Stanley and Bank of America, have already begun laying the groundwork by providing guidance and infrastructure to support crypto exposure. As fiduciaries grow more comfortable recommending digital assets within diversified portfolios, Bitcoin's investor base will broaden and stabilize. Finally, regulatory clarity through legislation could serve as a major catalyst. The proposed Clarity Act represents one of the most significant regulatory developments in the history of U.S. crypto policy. Passed by the House of Representatives and expected to reach the Senate in the coming months, the bill aims to establish a comprehensive framework governing digital assets, exchanges, and custody. For years, uncertainty over jurisdiction and compliance has constrained institutional participation. The passage of the Clarity Act would remove much of that ambiguity, enabling banks, asset managers, and financial institutions to engage with more confidence with crypto markets. As K33 notes, the banks have arrived. Their increased involvement would not only deepen liquidity, but also integrate Bitcoin more fully into traditional financial infrastructure. Such integration historically leads to greater market stability, broader adoption, and sustained capital inflows. When viewed in isolation, Bitcoin's recent underperformance may appear discouraging, but when examined through a broader analytical lens, it becomes clear that the underlying conditions tell a very different story. Bitcoin today sits at the intersection of favorable valuation, supportive monetary policy, political endorsement, institutional adoption, regulatory clarity, and structural supply constraints. Few assets, traditional or digital, can claim such a convergence of positive factors. As history has often shown, the most compelling investment opportunities emerge not during moments of euphoria, but during periods of doubt. According to the analysis presented by K33, 2026 may mark precisely such a moment for Bitcoin, one in which it not only recovers lost ground, but decisively outperforms stocks, gold, and other traditional assets. For investors, policymakers, and financial institutions alike, the message is clear. Bitcoin's next chapter may be its most consequential yet.